Hey everyone, welcome to another edition of Investing Counterpoint. Daniel, how you doing today?
I'm doing well. Thank you for asking on. I'm just like we're living in historical times. Remember, our show is for financial advisors, though it could be for any person that's interested in our take on the markets. But we're talking about markets, but we're also talking about how you as a financial advisor can manage risk for your clients. Very importantly, how you can be an expert, how you can talk about events through the prism of risk management with our experience. Talk to your clients, talk to your prospects, position yourself as a trusted advisor. And that's what our show is about. That's what it's for. And let's get going.
Yeah, great. So today we're going to talk about, there's been a lot of news about China recently. I mean, there's always news about China, but the latest news out of China isn't good. They've had, declining housing prices, declining employment, GDP slowing. In fact, it's even been acknowledged by, the vice PM, I forget his name. I don't think I could pronounce it properly anyways, but it's even been acknowledged that, these large manufacturing hubs, these large employment centers need to start doing more to turn the tide for China because they're struggling. And when you get official acknowledgement out of the Chinese government that it's not going well, in the form of, someone so high ranking actually saying it out loud, that could mean things are worse than we realize, because China has always been a little hard to know.
Shocking, right? I thought you could just lock down major metropolitan areas, weld people into their homes, and you can use tanks to disperse people away from the banks from which they're trying to get their money out. I mean, the audacity. And you could do all that and somehow not feel an impact. I mean, the one thing I will say is that if the Chinese data wouldn't soften now, I don't think there would be any credibility anymore for, I don't think there's a lot of credibility for data out of China, but I think there would be a lot less credibility. At this point, it'd be rock bottom. So it had to show some slowing. Yeah, I think it's a factor. But I think to me, we're looking at a very amazing, kind of confluence of events. We're seeing this incredible rally in the U.S. market, especially in tech, where in the previous shows we talked about how to manage risks and how to stress test for these sectors declining. And this is like a face-ripping rally. I saw a note somebody wrote that the shorts have been carried out on stretchers at this point.
Yeah, it's probably true.
It probably is very literally true in some cases. And so this is amazing rally. It's unheard of. The Fed is not done with hiking, not even halfway done, I think. Maybe more than halfway, depends. But by all accounts, they said they're going to go through with quite a lot of tightening. Then what we saw is that there was some ambiguous kind of press conference from the Fed Chair Powell where he talked about, we're going to be data driven. The markets, the algorithms, now it's no longer people, it's the algos that trade. They somehow took it as highly dovish, that meaning that, well, we're data dependent, meaning that we're going to consider to not go through with all the hikes that we talked about, which I don't think is what was meant at all. I think it's really like these machines are neural networks. Neural networks learn on some patterns. The only patterns they know is Fed being dovish. That's all they know, right? That's all they've seen in their data sample is Fed jawboning, trying to hike, and then going dovish. So they react the only way they could by just, shooting the prices up. I mean, GameStop is up again. I mean, it's like all this. Right. It's hilarity. I mean, it's really amazing to watch this because there's absolutely no economic basis for this rally. There's none. I mean, the earnings were decent for Google, but and a couple other companies, but overall, I mean, we're not seeing the signs that all of a sudden we should be in a booming market. The economy is contracting. The housing, which we'll get to, right? The housing is softening significantly. How can you have such optimism when you have housing starts, housing permits, housing prices dropping? And now China is a leading indicator because China produces goods for most of the developed world, for the US too. If China is showing a slowdown for some reason, that means there are fewer goods that will be sold in the US, period. So oil is down. Oil is down for other reasons, right? There's geopolitical stuff going on. There's lots of things, but still, I can't imagine where you have this situation where everybody thought that we're heading into serious turbulence. The Fed seems to have its credibility at stake. At the same time, we're seeing things like, oil is down, which usually is bearish, right? Usually oil is not down when you have good economic prospects. China is in trouble. We all know that. Housing is in trouble, and some other things. And all of a sudden, that's a rally, right? I understand why, right? Because these things, oil particularly being down, means less inflation. So the Fed, because they said they're data driven, maybe they're not going to go through all the hikes. But it seems like, to me, this is more like machines just doing the only thing they know how to do, which is buy on the news.
Yeah. Well, there are a lot of things that are down. I mean, wheat is down. I mean, there's other commodities too that are down that I would never have expected wheat to be down, given the situation in Ukraine and Russia and how big of a exporter they are of.
And the crops. I mean, the crops are failing around the world. I'm watching.
Yeah, I mean, so it's kind of it is kind of amazing. Yeah, it is kind of amazing. But I personally wouldn't read too much into this rally in terms of, affecting your view. I mean, the whole point of doing the stress testing is not to be right about the direction of the market. You don't stress test to predict where the market goes. You predict. Absolutely. You do stress testing to predict what's going to happen to your portfolio if the market does something. And, I went back and I looked at other crises like 2008, 2002, to see, did we have rallies like this? And we did. We also have rallies like this after
very well in 08.
In other bull markets.
January 08 was a big,
Yeah, there are plenty of them. I mean, you look back at May. I mean, May. If you look at May 2008 and you look about 18 months or so before that, it kind of looks like the previous 18 months right now. I mean, not exactly, right? I mean, the patterns are a little bit different, of course, but it looks similar. And in 08, we know that we had a big turnaround, but you can also go to 2015 and see something very similar, and that you had a bull market. So you can't read too much into rallies. They happen, it's kind of a natural sequence of people, selling, getting back in, calling the bottom, overreacting to some good economic news in either direction, overreacting in good news or for bad news. And so it's sort of a natural progression. And so the real question is, if we, because we are stress testing things and positioning portfolios to perform as well as they can, given, certain economic scenarios, what would we be looking at now? And, like you discussed, China and other emerging markets, what if they, start to really crumble under the weight of inflation, under the weight of, a decreased global economy?
They will crumble purely because of Fed's actions. There's nothing else needed. I mean, there's lots of things going on, but even if you removed all these other things, just simply the Fed acting on what they said they would do would crush them. I mean, it wouldn't crush them. I mean, like depression, but it would crush the growth. And so the point of our conversation is not that stress testing is no longer important because there was a 2-week rally in GameStop and meme stocks. That's not the point. The point is when you're as an advisor, when you talk to clients, they live the news cycle.
Yeah,
you need to surf it with them, but you need to bring them back to the core, right? To the basics. That's what pros do. When I played sports, that's what amateurs do, is they get carried away. What pros do is they get back to the basics when it gets tough. They can get carried away too, but when it gets tough, they get back to the basics. So you as a professional financial advisor, you should get them back to the basics, which is, positioning your portfolio for different kinds of scenarios, but doing it in such a way that you're not missing out on rallies. So go at least completely. So to your point, I would be stress testing right now. To me, oil down. I still think the Fed is going to go through with, and we have no reason to believe that they're not going to keep hiking, especially after this rally. It's like the markets are in a very weird reflexive relationship with the Fed in that, this rally, if the Fed were thinking about not raising the rates too much, now they have to, because their credibility, it's like, yeah, I'm going to raise rates. So wait, meme stocks are up. That's
well, but I mean, if they do show progress on inflation, which it is showing progress. I mean, these measures are down, and I don't think that they're done. I don't think they're stopping. I don't disagree with you, but I'm saying that I think that what was read by Powell, what he said, was that they're data driven, which means if they see their targets being met, they are going to slow down. And I think that they don't want to overshoot and spiral the country. They don't want to go up to another 150 basis points in the next 2 months, I don't think, and overshoot what is good for the economy, because they're doing a pretty delicate balancing act of trying to tame inflation and not crash the economy. And that's not easy.
Midterms. Maybe after the midterms, they'll go. My prediction is that after the midterms, they'll go full throttle, and they're gonna get their deflationary recession, and who knows what after that. But to your point, I think I would be stress testing emerging markets. There's no scenario. We can see many different scenarios, but I don't see any scenario where emerging markets come out unscathed out of this. And especially with the data in China, there's just a leading indicator. Right? And China is kind of the engine of growth. So we have emerging markets in portfolio crash testing, which is the app our clients use that you can also use and request demo for. Below the video, there'll be a link to request a demo for portfolio crash testing. It's our mathematical tool to help you model these scenarios. And you can see that there are different ones, but the emerging markets hard landing is the one I would look at for your client's portfolio. And when in PCP, when you select a scenario, you're going to see which parts of your portfolio do well and which parts of your portfolio do poorly. And to me, emerging markets hard landing, I would also do some stress tests around housing, but I guess we'll do it next time. We're trying to keep the shows fairly short, so it's actionable, 25 minutes or something. But take it away. Let's look at this scenario. You have a portfolio here. Yeah, I see.
Yeah. So I have a portfolio here. It's a conservative portfolfolio, or what I'm calling a conservative portfolio. And the allocation here is it's only stocks and bonds, but it's 63% fixed income, 37% equity. And we can do this with really anything, but we're going to try to mix up the portfolios every time and not just keep the same exact portfolio. You can do all your different model portfolios and things like that, in your own studies. But we have some value, some kind of things that you might typically think that would be in a conservative portfolio, including a little bit of real estate, which may or may not have a place in your conservative portfolio. But if we look at this emerging markets hard landing, let's just first talk about what this scenario actually is. The way that we described it is it says that China is not able to avoid contraction, and hard landing ensues. Well, we might be seeing exactly that. And so what we did in this scenario is we have, it's very simple. We're kind of letting the market correlations run their course, if you will. We're not stressing too many variables here, right? We have some of the biggest emerging markets here down 25 to 30%. And that's really it. That's all we're doing here. And so with the US markets, the European markets, spreads, rates, they're all doing something that might be a little counterintuitive. And one thing that you might want to consider adding to this emerging markets hard landing, if you're doing this scenario, is the Fed continuing to rise rates. We didn't do that here, but you could have.
Look at previous episodes. They're not meant to be 1 week kind of life expectancy. The episodes we do are about stress tests that are valid for years. So you can go back and watch previous episodes about Fed tightening and so on. That's
right. And so again, we just kept this really simple. And the results are kind of probably as you might think they would be. You have some of these bond funds doing well. And again, if you go in and you stress rates as well, like we've seen this year, some of these bond funds wouldn't be expected to do well naturally, but historically they would be. And if we get more of a true crisis type event out of these emerging markets, you might see bonds continue to rally because we've seen a pretty odd shape in the yield curve. So I wouldn't discount that this could happen.
Yeah, we have a whole
in the
show on the inverted yield curve and so on. You can,
Yeah.
basically we'll probably put it in the description as well.
That's right. And so you see some of the, the value indexes and mid cap and emerging markets ETF falling by quite a bit. And I only have a little bit of emerging markets in here in this portfolio. So it's kind of the expected culprits here, giving the biggest decrease in the portfolio, and some of the expected entities giving the an increase. The bond funds, some of the traditional bond funds giving a little bit of a cushion to this scenario. And so if we see emerging markets fall, you're going to see the U.S. fall. I mean, based on this, you're going to see property values fall, which we've talked about, which we've started to see. And you're going to see a bit of a flight to quality in the U.S. and for treasuries and things like that. You're going to see a bit of a flight to quality if it follows a sort of a more traditional path, and that shouldn't be a surprise to anyone.
Yeah, you should do this for every client. You should understand what the contributors are. In other words, we keep going back to this. It's not about predicting things, though it's very fun and it's useful to talk about scenarios, right? Scenarios have a hint of predicting the future, but predicting the future is really, that Yogi Berra quote, making predictions is really hard, especially about the future.
Yeah.
Actually, it was Niels Bohr, the physicist, who said that. But Yogi Berra said almost every wise thing that
I'm pretty sure Yogi Berra wasn't reading Milo, so I think I doubt he stole it. He must have.
Exactly. Yeah. It must have just the genius things alike.
Exactly.
So you need to run the portfolio through. I've actually met Yogi Berra, believe it or not.
Oh wow.
Yeah. I played sports. I played water polo for New York Athletic Club, and there was one reception. We were national champions. I mean, obviously that's not very a prominent sport in the States, but it was a very good team, and it was joined with New York Yankees reception. We were there was not just Yogi Berra. There were a bunch of players, some legends, and Yogi Berra is actually really, really funny. He has even bigger ears than I do, and they're very hairy, and he's actually funny. Whatever he says, and he looks wise. I mean, when you speak to him, it's not just a legend. I mean, he does seem like this little Yoda character. So it's pretty fun.
Yeah, rest in peace, Yogi.
Yeah.
So like we talked about earlier, you need to weigh the upside with the downside. So if we're looking at the emerging markets are landing down, 20% in this case, you want to take a look at stocks up 30%, for example, or a flattening of the yield curve, or whatever other positive scenario you come up with, to make sure that your performance is consistent with what you're promising clients. Because in the event that we have a rally like we've had over the past few weeks, and who knows, that could extend to months. I don't know what's going to happen, but you want to make sure that the portfolio is positioned in a way that your clients are going to be happy, not just looking at the downside. And that's really one of the keys with stress testing, because we can make this, basically zero, not necessarily in real dollars, but we can make it zero in terms of a loss by just going all to cash. But that's not going to make anyone happy on the upside, and that's not what you're paid to do. So really,
that's what we have always red and green. It's always both types of events on the same screen. It's like a diagnostic map. But yeah, and in the next episode, we'll talk about housing a little bit more. But the takeaway from this episode is that even if you don't hold China, if you don't hold emerging markets, that doesn't mean, you may not care about emerging markets, but they care about you. There's still a lot of interconnectedness in the global economy, and the data that's coming out of China is very serious, because remember, for years when people talked about a slowdown in China, the data would come out perfect, so everybody said, like, is this even real data? But now we have some confirmation that it's real data, at least to some degree. Maybe it became real for some reasons, but we're seeing a major slowdown in China compared to what was expected. And I would suggest that you talk to your clients about it. You talk about a bigger picture, right? Because what they see probably, if they care about the markets, they see this rally, but you talk about balanced portfolio, that looks at shocks like shocks in emerging markets, shocks in housing in the next scenario. So our goal with these episodes is to help you. It's like a chess player. My son is really into chess now. He's beating me now consistently.
Wow.
And I used to play, chess when I was young, fairly well. But he studies every kind of strategy. So for him, it's like scenarios. The ending with two horses. I don't know what it is in English, but two figures of this kind, against this kind, and so on, and different kinds of endings. He actually studies them. So when we get to the ending, I'm like winging it, and he has a plan. And
Right.
So it's the same kind of idea. You want to have a strategy for different types of scenarios and be ready, and also position yourself as an expert, because you can't win clients in this environment without being able to educate them. It's my opinion.
It's absolutely true. And, I think that the one takeaway that I think everybody should have is, if you're not, even if you don't care about China, China cares about you. And if you think about, just the effect that we had on the supply chain when we had lockdowns and China was, slow and we couldn't get, materials for our products that, so our scenario slowed just because we couldn't get things. Our economy slowed. So, don't think that it doesn't affect you, because these things are all interconnected. China going down does have an impact on the US and other, especially if we throw Brazil and India into the mix too. You don't have to explicitly hold China for that to affect you. But most of you probably already know that. So, but it is a very important point. This stuff's all interconnected.
All right, Jan. So we'll see you next week. We'll talk about housing.
Yep.
Good luck. Good luck managing client portfolios, protecting them, winning new clients, because that's what we're about, trying to help you win new clients as well. Remember, you can get a demo of portfolio crash testing, which is a software that we designed to help you do all this stuff. Of course, there are other ways you could do stress testing as well. You don't have to have PCT to watch the show, but you can request a demo and see how it works and how it can help you.
Yeah. All right. Thanks, Daniel. Thanks to everyone.
See you next week. Bye.